If you're wary about working with a financial advisor, or think you might not be getting the best advice, you may well be right. But with a little industry knowledge, you'll have a good chance at finding an advisor who will be both fair and knowledgeable. One of the most confusing and misleading aspects about financial advisors is their titles. When you sit down with someone called a financial advisor, financial planner, wealth manager, and so on, you may believe these terms indicate a level of professional expertise and even a trusted relationship with clients. The truth is that anyone can call him or herself a financial advisor, as confirmed here by FINRA, the very organization that regulates the financial industry. Unlike lawyer or doctor, there is no educational, testing, or experience requirement to use that term or these other common financial titles. So be aware, if you are talking to someone who calls him or herself a financial advisor, that person may not be qualified to give you the help you need. There are many credentials that a financial advisor can get, but are any of these really meaningful? Most are not. 3 of the most respected credentials in the industry are Certified Financial Planner, or CFP, Certified Public Accountant, or CPA, and Chartered Financial Analyst, or CFA. These designations have rigorous education, testing, and experience requirements and indicate a person has developed enough expertise to be qualified to provide advice. However, even if an advisor is credentialed, if he or she is a broker or sales agent, there is an inherent conflict of interest that makes it difficult for that person to give the best advice. A broker or sales agent earns money partially or wholly by selling you products. The more products he or she sells, the more he or she makes. This incentivizes the financial advisor to sell the most product, whether or not those products are actually in your best interest. We see the destructive results of this compensation arrangement all the time. Recently, 79 firms were fined by the SEC for harming their clients by pushing them into funds with high sales commissions, when comparable low-fee funds were available. We read stories like this almost daily. We also see the results when new clients come to us from one of these brokers and they have completely inappropriate high-commission products in their portfolios, such as annuities. Annuities pay one of the highest commission rates of any investment product. In addition to the sales commissions, agents often receive enticing kickbacks, such as all expense-paid trips to Europe and Mexico. These are actual ads geared toward sales agents. You can imagine that given the incentives, an agent would be tempted to recommend these products, even if they aren't the best fit for your situation. As the generation of baby boomers is hitting retirement, the insurance industry sees a tremendous opportunity to sell a lot of annuities. How are they planning to do this? One way is by inciting the fear of running out of money. In fact, they have actually formed a nonprofit organization whose purpose is to, quote, educate Americans about the importance of protected lifetime income, which is a thinly veiled reference to annuities. And you can see who they are targeting. As the sole sponsor of the Rolling Stones tour, they are going after baby boomers in a big way. If anyone is trying to sell you or a friend or family member an annuity, please beware. The confusion about titles and the conflicts of interest due to compensation has resulted in real harm to many clients. We see the results of bad advice all the time, but don't take our word for it. Just look at the disciplinary statistics from FINRA. In 2017 alone, advisors had to pay almost $65 million in fines for violations, and almost $67 million had to be paid back to investors. Those are staggering numbers when you think of all the individuals we see who are harmed, but are never part of a lawsuit against an advisor. So these are just the cases where charges were brought and the client actually won the case. On top of that, hundreds of advisors were barred or suspended because of their actions. And 2017 was not an anomaly. It was actually low in fines compared to previous years. The number of violations, fines, suspensions, and expulsions of advisors are high every year. There are plenty of reasons to be concerned about who you or your family members trust as a financial advisor. The clear alternative is to work with a fee-only fiduciary advisor. A fiduciary is someone who is required by law to always act in their client's best interest. While brokers and sales agents are not fiduciaries, registered investment advisors, or RIAs, are. In addition, a fee-only advisor takes a comprehensive look at your situation, not just your investments, and provides advice in all areas. We use an annual checklist with over 100 items to make sure we review every area of your finances each year. This attention to detail results in tremendous value for our clients. For example, we found one client was not receiving the correct amount of their retirement pension, and the correction resulted in thousands of dollars in back pension paid to the client, as well as a higher payment going forward. We have also found countless errors on clients' tax returns that resulted in thousands of dollars in saved taxes. You would think that because of the value provided by fiduciary advisors, they would have higher fees than the brokers and sales agents. But we have found the opposite to be true. Most clients who come to us from the large brokerage firms and banks are paying far more than what we charge. The large brokerage firms and banks have the advertising dollars to become household names. So when people go looking for financial advice, this is where they often end up. And they don't know there are alternatives. So how can someone find the right advisor? First, if you are already working with an advisor, look him or her up on BrokerCheck. This will tell you if the person is a registered representative, which means broker, or a registered investment advisor, which means fiduciary. It will also tell you what credentials the person holds and if there have been any disclosures or disciplinary actions against him or her. Be careful with advisors who are dual registered. This means they are both registered investment advisors and brokers. Often they will say they are fee-based. This is not at all the same as fee-only. They charge fees and can also earn commissions, so there are still conflicts of interest. The best bet is to find someone who is truly fee-only. The National Association of Personal Financial Advisors, or NAPFA, is the country's leading organization of fee-only advisors. You can go to their website to find a fee-only advisor in your area. At Bay Point, we are proud to be NAPFA members and to have built our practice 20 years ago around the principle of always putting clients first. If you are curious what a difference this can make in your finances, please give us a call.